The UK inflation rate slips lower for third straight month. Is China exporting deflation to the rest of the world? Argentina's struggle with hyperinflation continues. Recession risk in UK grows as companies go for rapid job cuts. These are some of the trending newspaper headlines. Not a single day passes without coming across terms like recession, deflation, inflation, hyperinflation, stagflation, or depression in the news these days. These terms may sound similar, but they are quite different in meaning and context. In this video, we're going to explain all these common economic terms in the simplest possible way. We are going to begin with inflation, the most common and frequent one, followed by deflation, hyperinflation, recession, stagflation, and finally depression. Inflation. In simple terms, inflation means a rise in the price level. Suppose you buy just 5 items daily: eggs, milk, fruits, vegetables, and chocolate. You calculate that last year you spent $100 on these every month. However, this year, your expenses for the same amount of these items have risen to $110. What has happened? Now, if you check the price of each of these items, you'll see that the price of some of the items, or all the items, has gone up over the year. This is what inflation is: a rise in the price levels leading to higher expenses. Let's look at the textbook definition of inflation. It says inflation happens when there is a sustained increase in the general price level in the economy. This means we're not just talking about a price hike in a single item, but an increase in the price of most goods and services. So when inflation happens, you're most likely to see a rise in the price of different goods and services, be it for cars, fresh fruits, electricity, or even movie tickets. Each country determines inflation by indices. In practice, the price of a similar basket of goods is looked at every month, which makes it comparable to previous months. Inflation is not that much of a problem if it is just a small percentage, like 2 to 3% per year. However, it gets problematic when it starts crossing 5% and moves towards double digits. For example, in June 2022, inflation in the US reached 9.1%. This means the general price level in June 2022 was 9.1% higher than the general price level in June 2021. So a grocery basket costing just $100 in June 2021 would have cost you $109.1 in June 2022. This was the highest inflation rate in the US in about 4 decades. The US Fed targets an inflation rate of just 2%. Inflation doesn't affect everyone equally. If you have a fixed income, inflation would lower your purchasing power significantly. You would be able to buy a lower amount of goods and services for the same budget. This is why inflation affects low-income households or fixed-wage earners the most. This is also another reason why inflation is such a huge political issue, because a majority of citizens in a country are more or less affected by it. Deflation. Deflation is the opposite of inflation. So if inflation leads to a rise in price, deflation leads to a fall in it. The main reason for sinking prices is usually sinking demand from consumers, which is not a good sign for the economy. As a result, earnings of companies will decline and companies try to reduce their costs. Such cost reduction measures are likely postponed investments, production stops, or even salary and job cuts. Obviously, this can easily lead to higher unemployment, which again reduces demand for products and services. If a government is unable to stop this circle, the economy enters into a crisis. For example, the US economy experienced deflation during the 2007-2009 economic crisis. This episode is also known as the Great Recession, and we'll explain the term recession shortly. Now, let's look at another red flag: hyperinflation. Hyperinflation. Think of a situation in which the price of bread doubles every day. This is exactly what happened in Zimbabwe 1.5 decades ago. Back in November 2008, the inflation rate of the country reached a staggering 7.96 billion%. This means prices rose by 98% each day. In this type of situation, you would have to carry a truckload of currencies to buy a piece of sandwich. Zimbabwe had to issue 1 trillion Zimbabwean dollar banknotes to deal with the situation. This was the worst record of hyperinflation in history. Yugoslavia also experienced hyperinflation between 1992 and 1994. During this period, the country's inflation rate peaked at a monthly rate of 313 million%. Hyperinflation is like inflation on steroids. Inflation becomes hyperinflation when it rises uncontrollably over a period, exceeding 50% per month. It is an extremely rapid rate of inflation that goes out of hand. This is an exceptional situation in which your purchasing power falls fast and drastically. The economy simply goes haywire in hyperinflation, pushing a lot of people into abject poverty. Most commonly, hyperinflation takes place when the government prints excessive money to pay for its expenses and run the economy. When the production in an economy is minuscule and there is too much money around, the economy's value of money shrinks, and what you get is a stratospheric level of inflation. Inflation, deflation, and hyperinflation are all related to price levels. Now, let's look at some terms related to production and economic growth. The first one is recession. Recession. The term recession has some chilling effects associated with it. Recession often translates into lower income, job loss, and even large firms shutting down. By definition, a recession occurs when there is a fall in the GDP for 2 consecutive quarters. GDP stands for Gross Domestic Product. It measures the market value of all goods and services produced in an economy in any given year. So, in a recession, there is a fall in the value of production in an economy. Recession indicates lower economic activities, which means lower income, lower employment, and lower purchasing power. This is a dark economic phase. The US economy faced a prolonged recession during 2007 to 2009. The US GDP fell consecutively for more than 2 quarters, and the unemployment rate, which was just 5% in December 2007, reached as much as 10% in October 2009. Next, we might slip into an even darker phase, a depression. It is the worst phase an economy can end up in. Depression. 33rd US President Harry S. Truman once jokingly said, "In a recession, your neighbor loses his job. In a depression, you lose yours." For real, depression has catastrophic effects on the economy. In a depression, there is a bloodbath everywhere, be it in the job market or in the stock market. Depression is just like a recession, except that depression is a longer, more severe, and more harmful to the economy. The textbook definition is that in a depression, there is a fall in GDP for a longer period, generally for more than a year. In a depression, the unemployment rate spikes into double digits. There is a collapsing demand for goods and services. Many companies go bankrupt because of a fall in profits and revenue. Investments dry up because no one wants to set up new factories or start a new business. At the height of a depression, the scene is like the climax of an apocalyptic movie. There is an eerie silence everywhere after all the death and destruction. One of the most cited examples of depression is the Great Depression in the US. It began in October 1929 and lasted for more than a decade. By 1993, about 25% of the workforce, that is about 13 million workers, lost their jobs. People who could manage to save their jobs saw their income fall by more than 40% in the same period. Around 5,000 banks failed, while the stock market lost about 90% of its value. Also, the real GDP fell by 25% by 1933. The Great Depression brought unimaginable miseries to the society. According to statistics, the suicide rate in the country rose by 22.8% between 1928 and 1932. It takes a pretty long time for an economy to come out of a depression. Also, there needs to be a combination of excellent economic policies to kickstart an economy after a recession. Depression is the last thing any government or a policymaker would want to deal with. Stagflation. Stagflation is a unique situation and something very difficult to deal with. It is a combination of stagnation and inflation. Stagflation has the features of both recession and inflation. Stagflation can start after some kind of economic shocks. For instance, a war in the Middle East would cause a sudden high increase of oil prices, so companies have to reduce their production due to the high costs. As the demand for products is still there, prices will rise, so there is an inflation. However, due to lower production, the economy shrinks and unemployment rises. Stagflation is difficult to deal with because if we want to take care of inflation, it might raise the unemployment rate. And if we want to lower the unemployment rate, it can lead to even more inflation. It's quite a tricky situation to be in. The US economy faced stagflation in the 1970s, when there was stalling economic growth, rising prices, and higher unemployment. However, note that stagflation is a rare occurrence. It happens when there is a unique combination of economic factors at play. In the words of Brad McMillan, Chief Investment Officer at Commonwealth Financial Network, stagflation seems to break the rules of how the economy is supposed to work. We hope this video helped you understand these common economic terms. Let us know your thoughts in the comments. Check out the channel for more videos about the business world, and don't forget to subscribe. See ya!